Hello and welcome back to the channel. My name is Zach Collins and this is Financial Education. Today I want to look at the top Australian ASX 200 ETFs that you can buy into, and I'll show you the differences because there are differences. Each company that is involved in listed securities has created it for a reason. Each index has own specific intellectual properties and each one can't be impinged. So we'll be going through that and discussing whether or not it actually makes a difference to performance. So the top three ETFs we'll be going through today is IOZ, that's by iShares, which is then the ETF division of BlackRock, which is the largest fund manager in the world. VAS by Vanguard, it's the second largest fund manager in the world. I mean, technically it doesn't follow the ASX 200, it follows the ASX 300, but for all intents and purposes, we're going to be treating it the same today. And finally, A200, and this is run by BetaShares. Now, BetaShares is a local Australian company, and they're reasonably new. They started up in about 2009. They've been around for a few years, but they're nowhere near as long as the decades and decades that BlackRock and Vanguard have been around. Now, I will link all three ETFs in the description if you want to read the PDFs directly. Let's talk about the specific indexes that they track. Before I get started properly, I want to say that when I give all my comparisons, I'll start with A200, then IOZ, and then finally VAS. Not because I favor one over the other, I'm simply doing it for alphabetical purposes. So don't let the order sway you one way or the other in your opinions. So what index do they track? A200 tracks the Sole Active Australia 200 index, IOZ tracks S&P ASX 200, and the VAS tracks the S&P ASX 300 index. As I said in my introduction, each fund needs to track something slightly different for intellectual property reasons. It's just like how there are so many phones, they all look the same, or at least very similar. They might tweak it slightly to get around the lawyers, but ultimately you gain a very similar product. The same thing happens with these funds. I'll show you very shortly. The top 10 are very similar. Actually, the whole fund itself is very similar. But the way these indexes differ will create slight differences, which bypass intellectual property laws and also has an impact on the returns as well. So one might perform better under certain market conditions, while another one might perform better in other market conditions. But given how small the differences are, overall it shouldn't make too much of a difference. Now, what are the top 10 holdings for each? I'm going to flash all three on the screen now, and then we can go through some notable differences for each. First thing of note is holdings 9 and 10. Now, BlackRock and Vanguard have Goodman Group and Woodside in the exact same order. BetaShares, however, have swapped them around. If you have a look at number 1, for example, all three of them have BHP as their number 1. A200, however, has it at 9.6% of their portfolio, IOZ 9.39%, and VAS 9.44%. It might not sound like a lot, but for every $100 that's in the fund, you're talking $9.60 in BHP within A200, $9.29 in IOZ, and $9.44 in VAS. Now, this is not investment advice, but outside of any holdings, within index funds, my wife and I refuse to buy mining companies. She's a geologist and has worked for BHP, Rio, and a bunch of other smaller listed mining companies. I'm not going to say what they do is dodgy, and you need to watch out, but her income is completely tied to the performance of the mining sector. As a general rule, not just her, but everyone is there's ESG issues. So given that, we've just decided to completely cut them out from our personal portfolio. Is what we're doing a good idea? No idea. But probably not. Considering the biggest sectors in Australia it's either housing or mining. But that's how we've decided to structure our portfolio. I just thought you might find it interesting. But back to the actual point of this video. Next on to management fees. Now, management fees, they're a contention for all ETFs. You do see investors arguing online about how you need the lowest fee fund or how it's a waste of money or whatever else that these people are doing. Now, there's a big reason for management fees. There's a lot of work behind the scenes, making sure that each fund is operating within the actual index, that they're doing research to ensure that they maintain specific competitive advantage. All three of these ETFs we're talking about today have really low management fees. A200 is the lowest at 0.04%, IOZ is then next at 0.05%, and VAS is at 0.07%. When you put that at a dollar perspective, If you have $10,000 invested in all three of them, A200, you're paying $4 for them to invest your money, $5 for IOZ, and $7 for VAS. Now, I don't know about you, but I definitely can't find a coffee for less than $5. And I've definitely spent over $7 on the odd occasion. So basically, all three of them will cost less per year to manage your money than it might cost you for your morning coffee. The last thing I want to go into today is, regarding these ETFs, is their performances. Now, you do need to take these numbers with a grain of salt. I'll put the three of them up on the screen now, and you can see they're basically identical over the long term. Now, unfortunately, A200 hasn't been around for 10 years yet, so we don't have the full numbers for it, but IOZ and VAS are within 0.1% per year difference in their return, which is absolutely negligible. And it's not going to make a noticeable difference to the value of your portfolio by picking one over the other. At other time points, you can see the differences are very similar too. Now, as I mentioned at the start, the difference is down to the investments that each of them hold. VAS holds 300 companies, while A200 and IOZ only hold 200. And it also comes down to the weights they allocate to each different holding. As I showed earlier, in just the number one holding, there's a variance of up to 0.31% between the highest and lowest allocation of that one stock. If the company had done well, then the ETF with the higher allocation performed better relative to the others. Alternatively, if it had underperformed, it means that relatively, the ETF would have also underperformed the others. As I said, you never know what the market is going to do on any particular day, week, month, year, or even decade. But what it does show is that over a longer period of time, there is very little difference between them. So which one is the best? All of them? None of them? Look, it all comes down to personal opinion. Vanguard is super popular as it was one of the first to offer ETFs here in Australia. It's a well-known brand and it's got a loyal following. BlackRock, on the other hand, is the largest fund manager in the world. It's got a really good reputation and has a really big following from institutional investors. When it comes to beta shares, they're a local company and they have the lowest management fee of all. Should we support local and cheap? Personally, I have an equal holding in all three. Just from a performance perspective, I don't believe any of them will perform better than the other. I just hold all three to spread my risk. I hope none of them ever go bankrupt and lose my money. But look, you never know. There is nothing certain in life other than death and taxes, that is. And so that's why I've got all three just in case. If I did pick one, I'd probably just flip a coin because there's really not anything in it. Hopefully I have been able to give you guys a better understanding of the differences between a range of funds that from first glance might seem identical, and the sort of things you'd be looking out for for your next investment. If you guys have any more questions, please feel free to drop a comment below and I'll answer it if I can. Thank you so much for watching, and I'll see you guys in the next one.